Mistakes in Investing by Mr. Utpal Sheth. And it is my pleasure to invite Mr. Varun Goenka, Managing Partner and Fund Manager, ValueQuest Investment Advisors. About Varun. Varun, prior to joining ValueQuest, has been the co-fund manager at Nippon Mutual Fund. With experience in 20 years in markets on both research and fund management, he has focused on consumer, technology and light engineering industries. Can I request, with a warm round of applause, Mr. Varun Goenka.
Good morning, everybody. Am I audible? So, for me, it's a moment of thank you so much, CFA Society. It's an honor to be here with Utpal Bhai. And for me, it's kind of a moment when the student is ready, the teacher appears. And it's truly a privilege to introduce Utpal Bhai to be here. I'll choose his own words to introduce him rather than going through the bio, which you can anyways access publicly. I would say most geniuses, especially those who lead others, prosper not by deconstructing intricate complexities, but exploiting unrecognized simplicities. These words were actually shared by Utpal Bhai himself a few years back, but it stayed with me, and this is exactly what he's able to do. And why is he able to do is what I'm here to share, which is probably lesser known and lesser discovered. So, there are a few investors or people in the country. We now know, let's say, Radhakishan ji because of the DMART IPO, Rakesh ji, of course, because of his media appearances and his being so vocal is known. But Utpal Bhai has been executing behind the scenes for last 20 years with RARE, with his firm Trust Capital, with an asset management firm Chanakya. So he's been far low key. It's just recently that he has made a few presentations, or let's say come on Wizards of Dalal Street by Ramesh ji, made the Mega Trends presentation at the CFA Society event at Delhi, is when actually people started discovering him in the last few years. But let me tell you, I don't have anybody come to my mind with such breadth and depth of experience, and let me elaborate there. I don't think so. There are many who can connect macro and micro the way Utpal Bhai does. Not many who've had such long public market experience, have done venture capital deals, M&A, buyout, private equity, and at such large scale as what we now know as outcomes like Star Health, Metro Brands, so many others. We know him for his Titan, and Shree Cement early identification, but there's a lot that is unknown. And today's discussion is also about an area which is far less articulated, either in academic or investing literature. The structure of the presentation would be that he will speak for 60 odd minutes. We will have around a 20-minute Q&A and maybe 1 or 2 questions from the audience, and it would be on the audience to hold him post the session offline. But otherwise, he is going to raise an area which requires a lot of wisdom, and especially for the people who are looking to have that rigor of research. He has shown and demonstrated that index or fund investing is probably the way to become rich, but if you have to create wealth, you have to take a path which is less traversed. I would invite Utpal Bhai to please come with further ado to really take us through what he's put together.
Good morning, friends. Am I audible? Yeah, thank you. First of all, thank you, Varun, for those kind words. To see Varun evolve and grow so well over the years, I'm sure he will go on to much greater things. Thank you to CFA Society for inviting me here. CFA Institute is very close to my heart, and it's a privilege to be here with all of you. And it's even better to be here with all of you in Kolkata. You know, there used to be this famous speech, friends, Romans, and countrymen. For me, it is friends, Kolkatans, and investors. So, thank you. I'm going to be talking about mistakes in investing. And I want this session to be very reflective and introspective for each one of us. It's a very delicate subject, not usually covered, and hence I thought it important to highlight this aspect. It's a lot about one's behavior, and investing is very much behavioral. Rakesh used to tell us that investing is not an act of smartness, it's an act of wisdom. So, I will take you on this journey about mistakes, but before that, I request you to join me in a small tribute to Rakeshji. So, next slide, please. Okay, sorry, I have it here. Rakeshji, whom we called as Bhaiya, he was much more than a friend, philosopher, guide, and mentor to me for more than 25 years. I've learned so much about investing, judging people, making mistakes, and correcting mistakes dispassionately. And each one of those words is important. I think one of Rakeshji's greatest strengths was judging people. And being dispassionate about mistakes is what made him great. He used to say that, investing is counterintuitive. You have to overcome your natural tendencies, your natural instincts. And I'll try and share some of those aspects with you. Rakeshji taught us to focus on reality and the strategic big picture. It's not about knowing the macro. It's about having a vision which is larger than today, which is beyond today, which is beyond tomorrow as well. He was unmatched for betting on his vision and sizing his bets to match his conviction. Very few people can do that. George Soros said, it's not about being right or wrong. It's about how much money you make when you're right and how much money you lose when you're wrong. Dhirubhai Ambani used to say, શું લીધું શું વેચવું એ નહીં કહેવાનું, કેટલું કમાણું અને કેટલું ગુમાવ્યો એ કહેવાનું. So, it's very important to be able to bet properly and then size the bet even better. And trust me, there is nobody who comes anywhere close to Rakeshji on that. He helped us understand and appreciate the power of time, the power of compounding, and the parabolic nature of risk and returns in all walks of life. And I have learned more about life Then about investing from Rakesh. He's always been a true friend through thick and thin, not just to me, but to almost everybody that came to know him. And he used to value relationships more than net worths. So, I will always miss him. I'll quote one sentence about that he used to say. Your patience may be tested, but your conviction will be rewarded. This was the essence of his wisdom, of his investing. I move on to mistakes. So let us first understand what are mistakes and think about mistakes. People talk about their success. People talk about how much money they made. People talk about the bets that went right. People rarely talk about their mistakes. Why is that? Because mistakes don't show up in the long run, okay, if you are successful. However, to my mind, it is the mistakes that define you. It is how you learn from your mistakes, how you deal with your mistakes that defines you. We are going to be talking only about mistakes today. It's difficult to judge mistakes. Mistakes are not known at a snapshot of time, but are only known over a long period of time. Especially the mistakes which have a very large impact, because the root of that mistake was planted a long time ago. Okay? In investing, mistakes are magnified by time. We always talk about compounding when we talk about investing. Trust me, mistakes compound, and compound big time. So, focus on mistakes, but not in the way that one would usually do. Okay? And I'll explain that a little bit more. Mistakes are known only through a process of deep introspection and multiple iterations. Both are very rare. Most people dwell on their successes, do not spend enough time on their mistakes. Rakesh used to be an iterative thinker. He was brilliant at it. He would have in his mind a clear bull case and a clear bear case on the same idea at the same time. He was an unmitigated genius. A genius who could hold two opposing ideas in his mind at the same time. That was the definition that Einstein used for geniuses. So, be ready to have deep introspection and multiple iterations of your thoughts, of your hypothesis, of your mistakes, and of your successes. The relationship between outcomes and decisions are not linear. Think a little bit about this statement. Okay? We usually believe that if you made money, then your decision was right. Need not be the case. This is a good way to think about it. The good outcome, good decision, and the bad outcome, bad decision is quite black and white. The gray here is the good outcome, bad decision, and the bad outcome, good decision. Okay? That is where you learn about your mistakes. We live in a dynamic world today where business models are evolving, technology and platforms are causing disruptions. So, embracing your mistakes is crucial. You have to develop a state of mind where you can embrace mistakes. Why? Because investing requires your state of mind to be right. Okay? You should not allow at any point of time anything to impact your state of mind adversely. Making a mistake disrupts your state of mind and it forces you to make the next mistake. In tennis, that's known as unforced errors. Okay? So, when you embrace mistakes, a mistake will not impact your state of mind adversely. We think of mistakes only where we've lost money. But that's the wrong way to think about mistakes. Because we look at loss. What we must look at is opportunity cost. Opportunity cost is a far more important variable. And when you shift your mind to thinking about opportunity cost, that is when you start realizing the quantum and the duration of the mistakes that you've been making. I hope to elaborate this a little more in the presentation going forward, but hold this thought, protect your state of mind, embrace your mistakes, and have deep introspection and iterative thoughts about both your successes and mistakes. Investing is a behavioral activity. So let me share one concept with you. This is a story about World War II, and there were US planes which used to come back with casualties. And those planes, when they were inspected, they identified bullet holes in different places in the plane. However, they used to find that the bullet holes were concentrated in the wings and the tail and were not hitting the engines. So they thought that we must reinforce our planes, reinforce the wings and the tail so that the planes are protected. Now, this is the logical way to think about it. This is evidence-based. However, it's not that simple. There was this gentleman, Mr. Abraham Wald, who had a different point of view. He suggested that we should armor the engine, whereas none of the planes had bullet holes in the engine. So why did he say that? This is a diagrammatic representation of that. He said it keeping in mind the principle that the evidence that you see may not be all the evidence that there is. This is the survivorship bias. The US military was only looking at the planes which did return to the base. It was not looking at the planes which did not return to the base. The planes that returned to the base had bullet holes in the wings and the tail. The logical conclusion therefore should have been the planes that did not return had bullet holes in the engine. Hence, reinforce the engine. So with the same data, you come to different conclusions. Which is why attribution of mistakes is crucial. Wrong attribution can mislead and lead to incorrect learning and rectification. I cannot emphasize this enough. I let this sink in. Okay, now we'll move on. Jeff Bezos, in his 1997 letter to shareholders, talked about decisions and mistakes both. He said there are two types of decisions: irreversible decisions and reversible decisions. He said irreversible decisions are like one-way doors and reversible decisions are like two-way doors. The one-way doors or the irreversible decisions need long and careful deliberation. The reversible decisions are changeable. So make these decisions fast and without perfect information. As investors, we are all operating in an environment of imperfect information. No matter how many analysts you deploy, no matter how many research reports you read, no matter how many brokers you talk to, we are all living in imperfect information. Rakesh used to say, we invest out of informed ignorance. Okay? This is how Jeff Bezos thought about decisions. So, you have to decide whether you're making reversible decisions or irreversible decisions. To me, fundamentally, that's the difference between trading and investing. In trading, you are making reversible decisions. In investing, effectively, you're making decisions which are not easily reversible, especially when you're playing at scale. Okay. So, all your decisions have to be seen in the context of three things. This is not what Jeff Bezos said. This is my takeaway from what Jeff Bezos said. Decisions are a function of reversibility, impact, and duration of that impact. Okay? When you add these three dimensions to your decision making, you will realize the importance of each decision making. We've all grown up listening to or reading Warren Buffett, who said that you are going to buy only 20 stocks in your life. You are going to make 20 investing decisions in your life. Never realizing the importance of that. It is when you think deeply about decision making, which could lead to mistakes, okay, that you start thinking about reversibility, impact, and duration of decisions. Lastly, Daniel Kahneman talked about loss aversion. He defines it as prospect theory, which says that the pain of losing 100 rupees is far greater than the joy of making 100 rupees. Okay? Charlie Munger also said the same thing, but in a slightly different way. This is a truth about each one of us. In fact, Charlie Munger goes on to say that investing is more about envy than about greed. Okay? You're always looking at how much the other person has made rather than looking at your own returns. You have to be able to steer your mind away from that. So the takeaway here is, again, to re-emphasize, protect your state of mind. Embrace potential mistakes, but keep iterating and validating so that you may correct and learn from them. Why embrace potential mistakes? Because if you don't embrace potential mistakes, you will have a huge opportunity cost. Like Samir was saying earlier, is distinguishing between good and not bad. People who get obsessed with mistakes will try and avoid them, will spend too much time on the mistakes, and in the fear of making that mistake, they will lose multiple opportunities. Keeping these few fundamental points in mind, we now move on to the types of mistakes. Okay? Now I'm working with you to build a framework for thinking about mistakes. So far, we talked about the foundations of mistakes. We thought about the context for mistakes. Now we are talking about the framework for mistakes. I'm bringing out this concept of types of mistakes from both statistics as well as accounting and economics. Okay? So the first type of mistakes is known as the type 1 error. This is the statistics definition. The type 1 error is the false positive, which means rejecting the null hypothesis when it's actually true, which in accounting and economics we call as error of omission. Okay? This is applied in all walks of life. So even in the medical context, for example, you have type 1 diabetes. Type 1 diabetes is where your body is not producing insulin, which is a false positive. Type 2 diabetes is where your body is producing insulin but not absorbing it. Okay? Which in statistics is known as type 2 error or a false negative, where you're failing to reject a null hypothesis when it's actually false, which is known in accounting and economics as error of commission. Okay? Now this is the black and the white. But like always, there is also a gray here. What is the gray? I call that gray type 1.5. Okay? Inadequate positive. Or the error of hesitation or reluctance, where you're failing to attribute adequate action in proportion to the potential, conviction, and validation. Okay? So in your mind, define all mistakes in one of these three categories: type 1, type 2, or type 1.5. Okay? And we'll see how these mistakes play out. Okay? On the buying side, when you are investing, you will have all the three kinds of mistakes. Type 1, you did not buy what should have been bought. 1.5, you did not buy enough of what should have been bought. And type 2, you bought what should not have been bought. With me so far? All of us, when we think of mistakes, think of the type 2 error. That we bought something that should not have been bought, which resulted in a loss. You have the same 3 mistakes on the selling side as well. The type 1 mistake for selling, which is you did not sell what should have been sold. Type 1.5, which means you did not sell enough of what should have been sold. And type 2, which is you sold what should not have been sold. Again, most of the time, we think about what we have sold which has gone up. Okay? However, we do not think about what we did not sell which has gone down. So once you start classifying mistakes in this framework, you will be better able to understand yourself. And understanding yourself better is the key to hopefully making lesser mistakes going forward. In addition to making mistakes in buying and selling, we also make mistakes at the portfolio level. Before I start talking about the mistakes at the portfolio level, I just want to ensure that mistakes in buying and mistakes in selling, we are all clear about that? Okay. Rakesh's portfolio was always quite publicly known. Most know about his successes. Very few know about our mistakes. Can someone talk about one of our mistakes at RARE? Excellent. Thank you. Any others? Exactly. We've had our share of mistakes. Quite a few of them. Okay? And as I explained to you earlier, after making each mistake, Rakeshji would tell us, no problem. I take full responsibility for your mistakes. Okay? Making a mistake is not a crime. Repeating a mistake is a crime. Not learning from that mistake is the biggest crime. So it was my privilege to be mentored by somebody like him. One of the mistakes that we see in most portfolios is building a correlated portfolio. And when I say correlated, I don't mean statistical correlation. Okay? It means having common drivers. People think of portfolio decisions as either being concentrated or diversified. People do not think of portfolio in the context of being uncorrelated, or what we call as idiosyncratic. Okay? Which means portfolio components that behave differently, that have different drivers. Okay? Second is that people do not think of balance. Irrespective of whether you have a concentrated portfolio or a diversified portfolio, your portfolio needs balance. An imbalanced portfolio can give you a great outcome. Once, twice, thrice maybe. But someday it will get you into big time trouble. So let me give you this example of a fund manager, very famous fund manager, whom I really respect a lot, Mr. Bill Miller of Legg Mason. There was a book on him called The Man Who Beat S&P 500. He kept beating S&P 500 for more than 15 years, I think almost 20 years, until 2008. In that 1 year, over the full period of 20 years or plus one, so 21 years, his performance and S&P 500 performance became the same. So you went right with an imbalanced portfolio for 20 years, almost 20 years. But the one time that you went wrong, it neutralized everything. All the outperformance of all of those 20 years was neutralized. So, having balance. Okay. In India, there is this PMS Bazaar performance statistics which comes up. And it measures the performance of all the portfolios, and every year there is somebody or the other who's really performing fantastically. And kudos to them. But there are a few funds who maintain brilliant balance through the years. And in the long run, they outperform. At size, at scale. So think about balance very differently. Think about correlation very differently, not statistically. Balance is all about weights. However, think of weights as beyond balance as well. Your portfolio composition needs to reflect weights in proportion to your conviction, in proportion to the validation of your conviction. Okay? If you don't do that, then you're not sizing your bets properly. There's this fantastic book by, I think, Annie Duke called Thinking in Bets. Okay? She's, I think, one of the greatest poker players of all times. And it talks about how to think about bets. So, this is a mistake that most of us make in our portfolio construction, and also continuing portfolio rebalancing. Lastly, the attribution and rectification of mistakes in your portfolio. We talked about attribution of mistakes in the context of the World War II example I gave earlier. But when you think about it in terms of your portfolio construct, if you do wrong attribution of mistakes, then you will carry the wrong learnings from it. Do your introspection, do your iterations, and keep revisiting till you arrive at the right attribution of mistakes. And what is most helpful is, after you arrive at the right attribution of mistakes, how quickly are you able to rectify the mistake? How much you learn from it? Sometimes, and most times actually, you have to, once you identify the mistake, and I'm distinguishing identifying and attribution of mistakes, okay? Once you identify the mistakes, you rectify it very quickly. And over time, attribute the mistake and learn from it. You need not wait to rectify the mistake until you have an attribution for it. So, I'm leaving you with 9 kinds of mistakes in general. 3 buying mistakes, 3 selling mistakes, and 3 portfolio mistakes. Okay? So, this is one of my favorite slides over the years. I say that the probability of making good investments is low, which is why Samir very correctly distinguished between good and not bad investments. So, for a moment, if we are to restrict the definition of good investments to only 5 factors: business, management, valuation, governance, and financials. And let us assume that you are an above average investor and you are able to judge each of these 5 variables with a high degree of probability. Okay? Remember that you have to get all 5 of them right. And in reality, there are more than 5 factors. In fact, in Samir's slide, I saw he had 8 factors. And trust me, there are more than 8 factors. So the joint probability of all of those factors coming together is very low. But assuming that you are above average and you get 80% of your business calls right, 70% of your management calls right, and so on, then your best case scenario is being right 14%. Your next best scenario is being right 6% of the time. And probably your realistic scenario is being right 3% of the time. So the probability of you making good investments is very low. However, you are not just getting one shot at it. Assuming you started investing when you were 20, you have a 50, 60 year investing life with you. Over that life, we will see how things evolve for you. I forgot to mention this part. Every decision has to be looked at in the absolute context as well as in the relative context. Relative to cash, relative to peers in your portfolio, and relative to other companies in your investment universe. I'm not even going beyond your investment universe. Okay? However, it is not a continuous game of optimizing. Because if you try to optimize continuously, you will miss the big waves. But that does not mean that you never optimize. You have to think relative, but in the long term. There's this book about Goldman Sachs. It says, be greedy, but be long-term greedy. So in the same way, here, look at things in a relative perspective, but in the long term. So this is the evolution of your portfolio over your investing life. So assuming you start investing when you are 20, and you start with say 15 stock portfolio, the probability is that only 1 or 2 of them will be right, and which may also have been an outcome of your luck. But you do end up with 1 or 2 stocks right. Thereafter, you have to keep defining the remaining part of the portfolio You should keep holding on to those one or two which were right until that hypothesis is reversed or broken. If you are able to refine your portfolio and come up with that one or two right every 4 or 5 years, then towards the latter half of your investing career, you will have a balanced portfolio. It will take you 20 years plus to get there. Okay? Which is why investing is a journey and not a destination. One or two right investments over a very long period of time turn out to be the gorillas in your portfolio. But why am I talking about gorillas? Let me elaborate on that. I'm using a slide which I had made at the Delhi CFA presentation as well about gorillas. These are gorillas. And as you notice, they are different from monkeys. There will be many monkeys in a jungle, but very few gorillas. So gorillas are rare. Gorillas are outsized as compared to monkeys. That means gorillas are dominant. Gorillas are not challenged by monkeys, which means gorillas have moats or edge. Gorillas have a lifespan double that of monkeys, which means gorillas have longevity. So the takeaway is to bet on the right jungle, which is bet on the right megatrend, and the right animal, which is the gorillas, which is leadership. So those one or two stocks in your portfolio will be rare, will be dominant, will have moats, and will have longevity. Okay? Look for those four. And those that don't, keep evolving that part of the portfolio. Okay? Now, if you thought that buying was tough, wait until you realize how tough selling is. Okay? Like Samir said, you don't make money on the shorting side in the long run. In the same way, but in exactly the opposite direction. You only make money on investing if you can eventually sell that and come out. Does not mean that the stock after you sell has to come down. No. Actually, probably the best selling decision would be the stock goes up after you sell. But your hypothesis is broken. Like Samir identified in the Fed governor's statement to the Congress, right? To the senator, which he said much earlier. But the effect in the market was felt much later. So don't be surprised if the stock goes up after you sell. That's fine. Because even if your selling was wrong, the fact is that you lost your conviction. Your conviction was broken at that point of time when your hypothesis is broken. So after that, if there is any volatility in that stock, you will be shaken. You will not be able to hold. So it's fine. The important thing is to maintain your conviction, to maintain your state of mind. When you lose your conviction, even if it is wrong, that's fine. Because it is your conviction which allows you to hold in times of volatility, to hold when there is a challenge because of external circumstances. There are some stocks in the rare portfolio that we've held with the stock not going anywhere for 3 years. But eventually when it did move, it gave us fabulous returns. So, let me talk to you about the probability of selling right. You can only sell something which you bought right. So, the 6% probability, assuming you are a normal seller with 50% probability of selling right, drops to 3%. So your eventual investment outcome drops to 3%. Is that concept clear? Why the selling probability is even worse than the buying probability? Okay. Now, we'll come to case studies. This was a stock which we never bought. Big mistake. However, our compounded returns from the time that I joined RARE is still good enough, despite making this big mistake. So you don't have to get everything right. You have to be comfortable with the thought that I'm not going to get everything right. I am going to have very, very big mistakes. Okay? But what I do want you to focus on, is this now? Here, is this. We have this mental framework of megatrends and leadership. We classify leadership as clear leader, near leader, and emerging leaders. So when we thought of Bajaj Finance, it was an emerging leader. As Samir pointed out, when he bought Bajaj Finance, he may not have thought that it would be such a great company, and forget him. Rajiv Jain himself might not have thought that it would be such a great company. Forget him. Sanjeev Bajaj himself might not have thought it will be such a great company. What amazed us is the pace at which it moved from being an emerging leader in the financial deepening space to being a clear leader. It is that change of position from here to here that gave you the 54% CAGR. Incidentally, I picked the same time that Samir picked, 2010. He did actually buy, we didn't. So, this is the mistake which has a very high impact on your portfolio performance. It never appears when we look at our P&L because it is opportunity cost. And we are the first to admit that we don't have what it takes to find every stock which has delivered the highest return in every sector. Not possible. This is the mistake of hesitation. Okay? So we bought CRISIL beginning 2002. And we used to hold 14%. ICICI Bank used to hold 9%. S&P used to hold 7%, or something like that. S&P wanted to increase its stake. They came to us to help them cross the 51% threshold. They made an open offer. We didn't want to sell, but we said we'll help you facilitate the 51%. They were running a few shares short of the 51% threshold. So we gave it to them. And we said, we'll buy it back. We thought that after the open offer, the stock price will correct and we'll buy it back at a lower price. We did not act. We failed to act. And the opportunity cost was massive. So Rakeshji has gone on record and spoken in different interviews that he bought a house. The house has become 2x since then. But the CRISIL shares that we sold have become more than 20x since then. So this is a mistake of hesitation on our part. We were supposed to buy back those shares which we had sold to facilitate the CRISIL entry. Because in the first place, we were not a willing seller. So this is our type 1.5 mistake. Our type 2 mistake, as Samir guessed correctly, A to Z. Our first entry was when it was a private company at a ridiculously low valuation. Subsequently, a private equity investor came in at between 10 and 20x of our entry price into the company. And we were very happy. We were sitting pretty. Even today, after all these years, the price is higher than our cost price then. However, the company came for an IPO in 2007-8. And the IPO was being undersubscribed. So we stepped in to help the company. And we applied in the IPO. Big mistake. We lost a lot of money on that IPO. So, for that mistake, we do not blame the promoter. We blame ourselves. We are a responsible adult taking decisions. That decision went wrong. The mistake lies with us. This was one big learning from Rakeshji. So long as you take responsibility of every mistake that you make, only then will you be able to address that mistake. If you don't take responsibility, if you blame it on the other person, you will not be able to address that mistake. This company, we had thought was a near leader, which we thought would become a clear leader, actually went in the other direction. We thought it became an emerging leader, but eventually it became a submerging leader. Let me share with you some mistakes on the selling side. This is the type 1 mistake of what we did not sell when we should have sold. This was a pharma packaging company which was catering to the demand for pharmaceuticals in India. It was a clear leader, probably in our mind, but at that time it was a near leader. Instead of becoming a clear leader, it went in the opposite direction. It made quite a few capital allocation mistakes, like A to Z. And we could see that. We should have sold when those mistakes were being made. We did not. So we ended up losing money on this. But more than losing money, is the regret is that this was an avoidable mistake. All the mistakes that we are talking about are decimal errors in our portfolio. But I cannot tell you how much we've learned from those mistakes. This is a very different kind of a mistake. This was a company we bought after it had already gone up 10x. And from the time that we bought, it went up further 50x in 4 years. And we sold. But this was the type 1.5. We did not sell enough. Nothing wrong with the company. The company delivered on everything. But the valuation had become so ridiculously obscene. We should have sold. We should have sold much more. We did not sell enough. Not only did we sell enough, we did not sell enough in 2007-8. There was a subsequent opportunity where the promoter sold some stake to the Tata Group and we had a tag-along right. And we did not exercise that right. So twice we made the mistake. This was criminal. We did not learn from our mistake. We repeated the mistake. We eventually sold. The price was not materially different, but there was an opportunity cost of 4-5 years in between. But I must reiterate, to date, I think this is a company which is doing all the right things. The type 2 mistake in selling. We had, I think, slightly less than 5% of this company. Today, buying 5% of this company will cost a lot. And we sold it too early. And internally we justify saying, okay, we sold Relaxo, we bought Metro. We got a higher return in Metro. But trust me, that's not true. As Rakesh ji used to say, dil behlane ke liye galib khayal acha hai. It was a mistake. We did not recognize the greatness of this company adequately. And the opportunity cost was 46% CAGR. We bought this company thinking it was a near leader and never realized it will be a clear leader. We bought Metro realizing it was a near leader, thinking that it will be a clear leader. But that is no justification to make this mistake. Because it was not a switch from Relaxo to Metro. Both the transactions happened in the same year, but it was not a switch. It was not a conscious switch. We had to look at it on a relative basis, relative to other stocks in our portfolio and relative to other stocks in our investment horizon, investment universe. So I know I burdened you with a lot of concepts today, which are quite nebulous, and I hope you'll appreciate that these are difficult things to talk about. But Let me try to put it all together for you. The first is to avoid mistake aversion. We talked about loss aversion, but I'm taking it a little further, avoid mistake aversion. Because in avoiding mistakes, you will avoid opportunities. It is imperative to plan for mistakes. Mistakes are a reality of life. So you have to calibrate exposure and have risk management, which will ensure that a mistake does not take you out of the equation. To take Sameer's casino example, you have to ensure that you have to be at the table. You cannot make a mistake which takes you off the table. Mistakes are known only through a process of deep introspection and multiple iterations only, but in the long run. Mistakes are seen usually in the context of losses, not in the context of opportunity cost. But opportunity cost is far greater than loss. And the portfolio evolves through mistakes. An iterative mindset is important, else you will end up with the wrong learnings. So I will end the presentation with 2 quotes of Rakeshi. The first one is, the greatest risk of investing in India is not investing in India. This shows how well he thought and understood about opportunity cost, though he never used that word in whatever he said. And the second is, making a mistake is not a crime, but repeating a mistake is a crime. Not learning from the mistake is the greatest one. This is his way of talking about how to avoid mistake aversion. And then Jeff Bezos, who says, I've made billions of dollars of failures at Amazon. Literally. None of those things are fun. But also, they don't matter. What matters is companies that don't continue to experiment or embrace failure. Eventually get in the position where the only thing they can do is make a Hail Mary bet at the end of their corporate existence. I don't believe in bet the company bets. Now, while he did not say this in the context of investing, it holds equally true in the context of investing. So, embrace your mistakes, have the state of mind which is resilient, which does not get adversely impacted with mistakes, have a risk management framework, a portfolio sizing framework, which accounts for possible mistakes, and trust me, it will help you be more at peace of mind, apart from also making you a better investor. Okay. I know I have bombarded you with a lot today, but thank you for bearing with me. It's a pleasure to share my learnings with all of you, and I'm happy to answer questions that you may have. I look forward to my session with Varun. Thank you.
We would be quite mesmerized or stunned, because this is not often that we get to hear cross that bridge from knowledge to wisdom. So what Utpal Bhai presented to us, maybe some of us would have taken 20, 30 years to understand, and we are really fortunate and lucky. Whoever is lesser than 30 is even more luckier. Some of us who are on the other side. So as they say, with great power comes great responsibility. I think such masters have the responsibility to share the learning, and I think what CFA Society is doing is not realizing the kind of impact and influence some of the early learners and us will have by hearing these people, and so that we could really shorten our learning curve, really learn, and it would have a magnifying impact on our outcomes. So thank you so much, Utpal Bhai, for taking the effort to put this kind of a distilled wisdom is really, really rare. There's no book you can pick it up or, so I'm really glad to be here. I would not let him go without a little peek into his personal life for 5 minutes. He has come from very humble beginnings himself, and rising to a stature of this level of experience, becoming partner and CEO at RARE, which is today the largest family office in India and probably one of the largest investors by absolute size. And he didn't stop there. He went on to create trust in Chanakya. So rather than the template, I would, Utpal Bhai, ask you, what is the kind of attitude that you lived which allowed you this kind of an aptitude and altitude?
Okay, I don't know about the altitude, but let me talk about the aptitude. To me, two things were important: learnability and adaptability. So I always had this quest to learn, and I hope that I'll have it to my last day. I have just followed that quest, ensuring that it is not just an ivory tower learning, okay, that I'm able to adapt to what I learn and then implement that and execute that. And it need not always be right. Quite a few things which have not gone well for me, but I'm okay with that. And I have learned to be resilient. So I would say adaptability, learnability, and resilience.
So assume we have a hungry person wanting to learn. If you could guide us on how would you separate what is signal and what is noise? Again, it's something that we all have to evolve over time, but and you are doing so many hats at RARE, from public market, private equity, and your two founding firms. So at least from our point of view, which most of us are more public market facing, how do you really separate signal and noise, yet have room for controlled experiments? Some mistakes are bound to creep in, but what not to do is getting even more challenging, and then we will definitely come to some questions on the presentations.
So I would say simplicity is not that simple, right? And therefore, while in your mind I'm doing quite a few things, in my mind I'm doing only one thing, and that is learning, adapting, and being resilient. It's not easy to sift signal from noise, but at the same time, it's also not too difficult to focus on a few things. I think when you have internal clarity, it's very evident of what you don't wish to do or what you should not be doing. Okay? And really speaking, there is no should not be doing, because something might work for someone else. You have to realize what works for you. So what you don't wish to do, you should be clear and derive everything from that.
Sure.
So to my mind, that requires a lot of introspection and understanding yourself. As Gautam Buddha said, it is easier to conquer the world than to conquer the self. And I think that's very, very tough, and I'm not sure that I have done it well enough.
Right. I think that's a quality of anybody being in the market long enough, anybody done it at a certain scale. I think humility sets in in ways that, the slide that you showed on joint probability, something in tidbits we all know how difficult it is, but you have quantified and made us realize really how odds are against us actually. So let me ask you some black and white questions. If we feel that our assessment is correct and we have a higher probability on all those 5 or 6 areas, then what is it should be our allocation to begin with? A range of number or something, you know.
Allocation to one stock,
Yes.
where you
Yes.
feel that you got all of
Yes.
that.
Yes.
Okay. So people think about that decision at a point of time. You have that higher probability in your mind today. But today is not the last time that you are going to be making that investing decision. So to my mind, depending on what your portfolio strategy is, you should have an opening position on that stock where it is not an insignificant stock in your portfolio. Okay? I'm emphasizing the word not an insignificant part of your portfolio. And then over time, as that conviction keeps getting validated and reinforced even more, you should keep increasing the weight, even if you're buying at a higher price. So, Rakesh bought the first Titan at 32 rupees a share in those days. But we bought Titan even at 120 rupees a share, 140 rupees a share, 400 rupees a share, 900 rupees a share. So, don't think of your buying decision as one buying decision at one point of time. You know, in physics, there is this concept of space-time continuum. Same way, there is a continuum of returns and time. Whenever you feel that it's the price and the probability equation is in your favor, you should go ahead and enhance your weight.
Sure.
And I think even Michael Mauboussin talks of the same thing, probability adjusted investing.
Sure. Right, so no anchoring bias obviously of a starting point for sure. A lot of us could have got into Bajaj Finance probably when it had already become 10x or such, but still the runway was so long, right? So as you showed in the mega trends gorilla opportunity, would you say that there's a lot of research breadth now, but the depth is getting more complex by the day? To be able to assess management teams, a lot of outcomes in such a VUCA world. So where do you think is individual investing? There are a lot of individual investors here. is the edge of individual investors diminishing in some way in favor of either institutional investors or professional team like yourselves, which are doing a very different level of depth in terms of work? Where do you think the scale is tipping towards?
Okay. So, Rakesh ji used to say that too much of analysis leads to paralysis.
Yeah.
Okay? So, I don't feel that there is anybody losing any edge because of too much information and so on. And your edge need not come out of greater degree of information. I think the whole markets are evolving from the importance of information to the importance of analysis to the importance of synthesis. Okay? Like we say that earlier search was important, now sift is important. Okay? Same way, from information to analysis to synthesis. But if you look at the distribution of the population of investors, only on one variable, which is time, then you will find everybody being concentrated on the 0 to 1 year.
Right. Yeah.
Very few concentrated between 1 to 3 years. And a minuscule minority concentrated between 5 to 10 years. So the moment you shift your time horizon to 5 to 10, you already have the edge.
Absolutely.
Right? The question is, do you have the focus and the discipline to shift your time horizon to 5 to 10? And Rakesh ji used to actually give us the freedom and the empowerment to think of even beyond then. So I feel that he empowered us in so many ways, and every investor has the power to empower themselves to shift your time horizon. And then you don't have to think about edge.
Since we are on this time horizon, you have explained on terminal value really, really well in the past. You covered it in your previous Megatrends presentation also. If you could, since it was not covered in this presentation, do help, change in terminal value is even lesser understood. Terminal value is hardly, if you could really spend, this is something again where academia or investment literature really does not. Theoretically, accounting wise, it is given some due in that DCF, but really it's not given its due importance. And
true. I don't know how much time we have.
yeah, we have only 5 minutes. So
to elaborate on that. But, a lot of people say that their style of investing is growth investing versus value investing. And we say that our style of investing is terminal value investing. We are always focused on the terminal value. And I'm sure you've heard of the chaos theory, where the flipping of a butterfly's wings causes an earthquake somewhere.
Lorenzo effect, yeah.
Right? Any change in the terminal value has an outsized effect on the price. So one has to keep thinking not just about the terminal value, but also about changes in terminal value. And while very few people get the terminal value right, even fewer people get the change in the terminal value right. So we all talk about moats, for example, and competitive advantage. However, your best returns come from companies which are widening their moats and elongating their competitive advantage. So, there was this movie called In Pursuit of Happiness.
Oh yes, of course,
Right?
beautiful movie. Yeah.
I would say we are in pursuit of terminal value.
So the forum has added 10 minutes to your thing, added more terminal value, so to say. Yes, so change in terminal value could be driven by regulations or competitive. If you could share one case study of how either a positive or a negative change in terminal value was a decision making.
Okay. So first of all, let me clarify that once upon a time, terminal value used to be driven by intangibles, somewhere around the time that I started my career, which is mid-80s, early 80s. But today, most of the terminal value and change in terminal value is driven by intangibles. It's far more difficult to understand intangibles and appreciate intangibles because you can't quantify it. It's not a mathematical formula. There are factors which contribute to terminal value, which I call as the 3 I's. One is inevitable, second is irreversible, and third is irreplicatable. Okay? When you find these 3 factors in different contexts, in any company, you can be sure that it will create terminal value. However, I will add that all of these are dependent on the culture of that company. Okay? Because you can replicate somebody's manufacturing process.
Yes.
You can replicate somebody's distribution strategy. You can copy a product. You can spend money on branding, but you can't buy culture. So culture is one of the largest intangibles. And I can give you stories after stories, but let me talk about our investment in Metro shoes. I'm not talking about Titan because it's been talked about enough. But Metro shoes, when we invested, as I explained to you earlier, we realized that this company is a near leader which will become a clear leader. But the culture that we saw in that company was phenomenal. There were various facets to that culture, but none captures that as well as one video of Rafiq Bhai addressing his staff during COVID times, which was actually never authorized. It was an unauthorized video which went viral subsequently, of how they have this culture of finding opportunity in every crisis, of never wasting a crisis. Okay? And it was that resilience, okay, that was truly inspiring. And what was the importance of that resilience? Every business will have cycles, but when a company like that faces a challenge,
Become stronger. Yeah.
it will become stronger. When all its peers and competition will become weaker, it will bounce back the first, and it will bounce back the fastest. It will bounce back the greatest. And that will keep creating value in every economic cycle. So there's this concept of creative destruction. Right? So This is the kind of company that will create even more value through every business cycle,
Very rare.
right? Hence, I would say that your ability to find those companies and those cultures which will create value is most important. I don't know if that answered your
No,
question.
absolutely. And that actually, in some way, also says measuring culture requires the level of focus beyond that 3-5 year horizon, or the research rigor, or the dedication. So it will not come on a platter to somebody on an annual report, or a con call transcript, or a broker report. So yes, so again, one of the areas of investors to understand is the least spent area, which is corporate culture or management culture. Very few have been able to, but let me just share, if it was so easy to replicate something, McDonald's tried to create a pizza franchise in late 80s and it couldn't do it, even the might of McDonald's. And there is only one Starbucks in the world, even though it's just coffee. So I completely, and I think yesterday evening when we were discussing, just like there is only one Titan in the world and there's going to be no second Titan, no second Bajaj Finance, these companies who are able to create that operating culture, replicate it at scale, are so few and rare. Just to, since we have only 5 minutes, any particular industries, Utpal bhai, that you can share that you see where there is significant change in terminal value? There are so many new industries that are coming up, so many existing industries that are changing form. If you could separate that barbell into the direction of where you see getting value created and value getting diminished.
So Arun, I think about it a little differently. To me, it is not the industry that creates value. It's the company that creates value. And what happens is, in any emerging industry, that industry will go through an S-curve. And during the first phase of that S-curve, you will have a lot of people entering that industry.
Sure.
Okay? It is very difficult to find the winner in that phase. Okay? It's relatively easier to find the winner in the subsequent phase, right? Where you have the hockey stick, a part of the S-curve. However, after that you have the third phase, where that industry comes down and every weak player is shaken out of the industry. We find that you have the highest probability of identifying that great player in that industry in that third phase.
Sure.
It may not be the lowest price of that company, and which is why I continue to maintain that Berkshire Hathaway's acquisition of Apple stock, even at such a high valuation, so late in Apple's life cycle, but that outsized bet would not have been possible in the early days of Apple.
Absolutely.
Right? So, that is one more lesson for us. It's not important to catch the stock in its infancy. It's important to catch the stock when it is evident to you that this is a greatness stock.
It's crossed the chasm, so to say. Right, absolutely. So there's nothing called missing out. You know, there is enough time, and if the runway is that long enough, we will have enough time. Right. You've spoken about, Rakesh ji and given him tribute and learned him. Just one thing I wanted to always ask: how can two people with such contrast personality. You are far more calmer, far more articulate, far more soft-spoken, and he's on the other side that way. So how did this team really create that magic that we now know?
I think credit goes to Rakeshi, that he put that faith and trust, that he provided the right environment and empowerment, and the right leadership as well. So, but at a personal level, I felt that we complemented each other.
Right.
Okay. And you know, in a car, you require two things. You require an accelerator and you require a brake.
Right.
Right?
It's well said, yeah.
And I think we were very complementary in the sense when he was being the accelerator, I would be the brake. And when I was being the accelerator, he would be the brake. And the balance worked well. Also, our strengths were different.
Yeah.
And it is the coming together of those strengths that helped put the magic together. Though I'm sure Rakeshji was a one-man army in many ways, and he would have done wonderfully well without me. I'm not sure that I would have done wonderfully well without him.
Yeah, that's again being very modest, but those of us who know, we know the kind of structured process, the kind of thinking that you got to rear, of course, you know. I would strongly recommend the audience, in case you all have not seen the Mega Trends presentation, I think shown a year back at the Delhi CFA event, and also Ramesh ji's Wizards of Dalal Street episode on Utpal Bhai. The reason why I'm saying is, you need 2 or 3 people in life maybe which can give you that energy, that channel, that focus and that guidance. The sooner we get it, it is better. And Utpal Bhai, I would say, if let's say Buffett built a generation of investors, today let's say we have to read Don Valentine or Michael Mauboussin, Utpal Bhai is bringing a lot of original wisdom to us, which is very hard to get by. Not to embarrass him further, but some closing note from you, Utpal Bhai, would really help to guide everybody.
Okay. So first of all, Varun, thank you for those kind words. I would just say, keep learning, keep adapting, and keep investing. Don't be afraid of mistakes. Embrace mistakes, protect your state of mind, and trust me, it's a journey which is very fulfilling, not just because you make money, but because you also learn. You become a better investor and a better person every day. All the very best to each one of you. It was good for me to interact with some of the youngsters here yesterday evening, and I look forward to more interaction today. Thank you.